Welcome to the deep dive. FedEx just dropped its Q1 Fiscal 2026 earnings, and well, the headlines are buzzing.
They certainly are.
This deep dive is your shortcut to understanding the most important takeaways from their latest report. We'll really focus on those earnings results and the forward guidance that's got the market talking.
Definitely. It's quite an interesting report, especially thinking about how investors felt beforehand. There were some real concerns.
You're right, and that initial market reaction was pretty strong, wasn't it? Shares jumped over 4% right away.
Yeah, then settled even higher, around 6.3% up after the release.
And you can see why. FedEx really sailed past what analysts expected on both revenue and earnings per share.
Exactly.
So the revenue number was $22.24 billion. That's quite a bit higher than the $21.66 billion estimate.
Solid beat there.
And for diluted EPS, this is the adjusted non-GAAP number. It hit $3.83. Again, comfortably beating the $3.59 estimate.
And just quickly, that adjusted non-GAAP figure, it essentially strips out some one-off costs, right? To give a clearer picture of the core operations.
Exactly. Things like restructuring or spin-off costs. Helps you see the underlying business performance better.
Which makes that strong beat even more significant, especially given the pre-report jitters. Big names like Bank of America, Evercore, they'd actually issued downgrades.
What was the main worry driving those downgrades?
A lot of it centered on the loss of something called the de minimis exemption. Basically, this used to let small international packages skip duties and heavy customs checks.
So losing it means more cost and hassle for those smaller international shipments.
Precisely. And BofA estimated something like 17% of FedEx's international volumes might feel the pinch. So the surprise really is how well FedEx managed.
Right. Analysts called it strong execution, expanding margins, even with that headwind hitting air freight rates.
It really suggests they're, quite adept at navigating these tricky global trade shifts.
That resilience is definitely key. But let's dig into the how. How did they pull it off? What were the main drivers within the business?
Good question.
Because the overall picture, the consolidated operating results, they did improve year over year.
They did.
And FedEx is mostly pointing to strong U.S. domestic package revenue and those ongoing cost cuts they've been working on.
Right, the structural reductions.
Although, it's worth mentioning, there was a small hiccup, a non-recurring income tax expense, about $16 million or 7 cents a share, but still a strong quarter overall.
And if we break it down by segment, that gives us, I think, the clearest view of where things are really working well and maybe where the challenges are.
Okay, let's do that. Where should we start? Express.
Yeah, let's start with Federal Express. I mean, it's huge, right?
Okay.
It generates about 2/3 of their total revenue.
Wow, 2/3. So how did Express do?
Really strong improvement there. Operating income jumped 19% to $1.138 billion.
19%, that's substantial.
And the operating margin expanded, too, from 5.2% up to 6.0%.
Okay, so what specifically drove that? Was it cost-cutting mainly, or pricing, or volume?
It looks like a mix, but yields and cost management were definitely central. They got higher yields, basically, a better price per package on both U.S. domestic and international priority stuff.
So not just moving more boxes, but making more on each box.
Exactly. That's powerful. And that was paired with, continued savings from their big transformation programs.
Did volume play a role too?
It did. U.S. domestic package volume was up. Average daily volume rose 5%. And total average daily volume across Express was up 4%. So yeah, more packages and better pricing.
That sounds like almost everything going right for Express. But there must have been some headwinds, too. It's never that simple.
No, you're right. Those gains were partly eaten into by higher wages and purchase transportation costs. Plus, the sort of murky global trade picture still impacts international export demand.
And didn't they lose that Postal Service contract, too?
Yes, that had an effect as well. But there was a really big positive counterpoint. Fuel costs.
Fuel.
Yeah,
Always
right.
A big factor. What happened there?
It dropped significantly for Federal Express, down 20% in the quarter. Went from about $954 million down to $760 million.
20%. Wow, that's a huge help on the cost side.
Absolutely. It just shows how much something like fuel prices can swing things for a company like FedEx. Managing that is a constant balancing act.
Okay, so Express saw strong improvement, helped significantly by yields and lower fuel. Now, what about the freight segment, their LTL trucking business?
Right, the less than truckload side. Handles bigger shipments, consolidates freight.
Did freight follow the same positive trend as Express?
No, actually. Freight's performance went the other way. Operating results there decreased.
Decreased how much?
Revenue dipped 3% to $2.257 billion, and operating income fell quite a bit, down 18% to $360 million.
Ouch, 18% down. That pushed margins down too, I assume.
It did. The margin contracted from 18.8% down to 16.0%. Still profitable, but a noticeable dip.
What were the reasons they gave for that weaker performance in freight?
They cited lower revenue, like we said, but also higher wage rates. And interestingly, a strategic investment, they've been hiring more dedicated LTL sales staff.
So, hiring more salespeople. That sounds like playing the long game, maybe sacrificing a bit of short-term profit for future growth.
That's likely the thinking, yes. It's an investment to try and grab more market share and build relationships in that very competitive LTL space. So, a cost now, but potentially a payoff later.
Interesting dynamic, express surging, freight taking a step back, but maybe investing for the future.
Exactly. And remember earlier we mentioned those adjusted figures.
Yeah, the non-JAP ones.
Right. Just to reiterate, those adjustments are key because they pull out costs like business optimization, restructuring stuff, and the expenses tied to the planned freight spinoff.
Okay.
For instance, those business optimization costs actually came down by nearly 48% this quarter to $67 million. That suggests they're making progress on those efficiency drives.
So looking at those adjusted numbers helps you kind of see the core engine running separate from those special projects or one-offs.
Precisely. Gives you a cleaner look at operational health.
Okay, so taking these Q1 results together, the good, the bad, the adjusted, what does this signal about where FedEx is heading? What's the forward-looking story here?
Well, this is where it gets really interesting. They didn't just report Q1, they gave full-year guidance for fiscal 2026.
Ah, that's a change, right? They'd only been guiding one quarter ahead recently.
Exactly. This return to full-year guidance signals, perhaps, a bit more confidence or visibility.
So what are they forecasting for the full year?
Pretty strong revenue growth, actually. They're projecting 4% to 6% growth year over year.
4 to 6%. That's quite a jump from their earlier estimate, wasn't it? Something like 1.2%?
Yeah, much higher. So definite optimism on the top line.
And what about earnings per share for the full year?
The projection there is for adjusted non-GAAP diluted EPS between $17.20 and $19.
Okay, $17.20 to $19. How does the middle of that range compare?
The midpoint, $18.10, is just a touch below the previous estimate of $18.21. So strong revenue growth, but maybe slightly moderated earnings expectations compared to before. Still, a confident outlook overall.
That confidence, especially on the revenue side, must be backed by some specific strategies or expectations. What's driving that positive view?
A huge piece is definitely the plan to spin off FedEx Freight. They reaffirmed that's on track.
Right, the LTL business becoming its own publicly traded company, FDXF.
That's the one. Planned for June 2026. They're aiming for it to be tax efficient for shareholders, and they've already filed the paperwork with the SEC and the IRS.
Why is that spinoff seen as such a positive driver? Is it just streamlining?
It's partly streamlining, but it could also unlock value. You know, freight has different characteristics than express lower growth, maybe more capital intensive. Separating them could let the market value the higher growth express business more appropriately.
So the idea is maybe the sum of the parts is worth more than the whole?
Potentially, yes. Two focused companies, each with its own strategy and capital plan, might create more value overall.
That makes sense. What other strategic moves are bolstering this outlook? Any big wins or changes?
Well, they announced a nice new customer win. Best Buy is coming on board nationally. That's significant.
Definitely a good win.
And don't forget the planned rate increases. As they announced before, FedEx Parcel and Freight LTL rates are set to go up by an average of 5.9% starting January 5th, 2026.
Right, those annual increases always help the top line.
They do. And on the shareholder return front, they've been active. They bought back $500 million worth of shares in Q1.
How many shares was that?
About 2.2 million shares. That actually boosted the Q1 diluted EPS by about 2 cents. And they plan to keep buying back shares. They still have $1.6 billion authorized for repurchases.
So returning cash to shareholders while also investing, is there any link to the wider economy in their thinking, like interest rates?
Yes, they did mention that. Their view seems to be that if the Federal Reserve starts cutting interest rates, that could be a further positive for their guidance.
How so?
Because a good chunk of their highest margin business apparently comes from manufacturing customers. And those companies tend to benefit directly when interest rates fall. potentially boosting demand.
Ah, okay. And what about costs? They mentioned cost cutting earlier. Is that still a big focus?
Absolutely. They reaffirmed they're on track for $1 billion in permanent cost reductions from their ongoing transformation efforts like Network 2.0.
Network 2.0, can you remind us what that involves?
Sure, it's their big initiative to better integrate the express, ground, and freight networks. Historically, they operated quite separately.
So trying to run things more like one unified network?
Exactly. Using shared facilities, optimizing routes, more unified operations overall. The goal is more efficiency, lower costs, better service. It's fundamental to hitting that $1 billion savings target.
Makes sense. And are they still spending on upgrades, capital expenditures?
Yes, planned spending is still $4.5 billion. But the focus is very much on network optimization and efficiency. Things like modernizing the fleet, upgrading facilities, bringing in more automation.
So targeted spending.
Right. And they're also managing other costs, like
Yeah.
pensions. They lowered the forecast for pension contributions for the year down to maybe $400 million from up to $600 million before. It all points to a pretty disciplined approach to capital.
So wrapping this up, this deep dive really paints a picture of a FedEx that's not just reacting, but actively trying to shape its own future, doesn't it?
I think so, yes. Through strategic moves like the spin-off, disciplined cost management like Network 2.0.
They delivered a strong Q1, especially in Express, gave that confident full-year outlook, and they're making these big structural changes.
Indeed. It shows a disciplined approach to allocating capital, all while trying to create long-term value for stockholders in what's still a pretty dynamic global market.
It really is a company in transition. Which brings us to a final thought for you to consider.
Yep.
Given FedEx's big push towards one FedEx consolidation and this Network 2.0 integration, how might spinning off FedEx Freight by June 2026 actually sharpen the focus of what's left? Could this lead to more specialization for the remaining FedEx Corp, or does it challenge that whole integrated service model they've been building? Something to think about as we watch how this all unfolds.